Hi, everybody. It's November 5th, 2020. Welcome back to the Investor's Guide to Thriving and to the day after the so-called US election. Well, after last week's 5% drops, markets have decided that any and all news is good news, even though we're still not sure who the US president will be or who will control the Senate. Yet we're back to near all-time highs. Well, since it might be a few more weeks before Trump's legal challenges are settled, we've got a few more of these webinars scheduled. Every Thursday at 7 p.m. Eastern Time through December 3rd, in between episodes of Berman's Call, which has returned to its usual time slot Mondays at 11 a.m. Eastern Time. And we hope that you can make time to help Larry and I support childhood leukemia research. It's the Sick Kids Foundation, and Alzheimer's and dementia research at the Baycrest Foundation. If you'd like to make a donation, please use the links in the survey you'll receive after the event. This is how Larry and I are able to track and match your generosity. Thank you so much for those of you who have already donated. That survey is also your gateway to access the webinar replay. It'll arrive in your email tomorrow morning. Tell us how we did, and you'll get a link to access all the above and submit questions for the next webinar. As usual, we're thrilled to bring you Investor's Guide to Thriving, and we're able to do that in large part thanks to the support of our excellent partners. This includes National Bank Direct Brokerage, who supports not only this series, but also Larry's Investor 101 videos on YouTube. If you like the videos, you click the subscribe button and click the little bell next to it as well. You'll be notified every time Larry posts a new video to his channel. Here tonight to give you an overview of their state-of-the-art investor platform and how you can get 200 free trades is Ann Lee from National Bank Direct Brokerage.
Thank you, Jared, for the introduction. And good evening, everyone. My name is Anne, and I am one of the business development managers at National Bank Direct Brokerage. And again, we're very happy to join this season in support of Baycrest and Sick Kids, and of course, all the work that Larry has done for these foundations. So typical disclaimer, I'm here to remind you all not to take anything that I say as actual advice or recommendations. National Bank Direct Brokerage is self-directed after all, which means it is expected to do your own research and due diligence. So as for tonight's topic, I will be going over writing covered call options, as well as the why and how to use them in your own portfolios. So to preface, an options contract is essentially an agreement between two parties, so the buyer and the seller, in order to facilitate a potential transaction on a specific stock at a specific price and by a specific time. So in our case tonight, what does it mean to write a covered call option? So first, to briefly explain what it entails to buy a call option, it gives the buyer of the contract the right, but not the obligation, to buy the stock at a specific price within a specific time period. So as the buyer of a call option, in order to receive this right, you must pay a premium to the seller of the option. Now, when it comes to writing a call option, you're now the seller of this call option, which means you have the obligation to sell the underlying at a specific price per share if and when the buyer of the contract decides to exercise his or her right to buy. So to compensate for this risk, if you want to call it, the seller receives a premium from the buyer of the contract. Now, the thing to keep in mind with writing covered call options is that you do have to own the underlying in your portfolio. So on the next slide, or actually on the previous slide, it will show you your obligations as the call option writer or seller. So like I said, you now have the obligation to sell the stock at a specific price if and when the buyer exercises his or her right to do so before or on the expiry date. Now, because of this arrangement and the unknowns associated with it, that's why the buyer of the call option pays the premium and the seller of the call option receives the premium that is paid by the buyer. Now, you might be wondering, why in the world would I write covered calls? And I'm sure there's many reasons why, but it's usually because you're either expecting the premiums earned to offset and potentially protect from a moderate decline in price of the underlying, or maybe you want to sell your securities that you already own in your portfolio, or maybe, like many others, you're using this as a way to generate some income. Either way, writing covered call options is better suited if you believe the price of the stock, ETF, whatever, will not move much in the short to medium term. So if the underlying has been moving between a range and you expect it to continue doing so, then this might be an ideal strategy to implement. Now on the next slide, let's actually put this into example and apply reasons 2 and 3. So let's say you bought 100 shares of ABC at $65 each, and you're willing to sell and take profits at $67 each. On the next slide, it will show you the exact same scenario and the maximum profit and loss if you were to utilize this strategy. So by writing one ABC call option with a $67 strike for $1.50, your max profit is $350. The break-even point is $63.50, and then the next slide will actually explain the math behind these numbers. So the maximum profit is easy to calculate. The strike minus the price you paid for the shares itself, plus the premium that you received. And of course, don't forget to multiply it by 100 shares per contract, which will give you the 350. Now the break even is even more simple to calculate. You would just have to subtract the $1.50 premium from the $65 that you paid per share, which gives you a break even price of $63.50. And then finally, you might be wondering, what is the maximum loss? Well, theoretically, if ABC were to go bankrupt the next day, your loss is pretty much the entire thing that you put into it. But the small saving grace is that you did receive the $1.50 premium. Now, the next slide, I'll touch a bit on reason number 1 as to why you would implement a covered call strategy, and it's essentially to act like a protection level. So the premium that you receive from writing call options is essentially used as a protection against the share price falling, but it's only up to a certain price. So this is where you would estimate the potential decline before implementing this strategy. Because if you expect the share price to go down quite a bit, you're probably better off just selling the stock outright. But if you estimate a more narrow range that the underlying will be trading in a more short-ish time frame, then covered call options could reduce the impact of the small decline. Now, moving on, how does it look like to trade options on our platform? So first, you would pull up the stock by entering in the ticker symbol, the company name, whichever. And because we're specifically looking for option chains for Suncor in this case, you will select the options tab kind of in the middle on the right-hand side. And then next, you'll see all the various option chains once you click on the options tab, as well as a filter tool to narrow down your search. So let's say we'll filter the contracts out for those that are expiring in January, call options in our case, and we're not too picky on the strike price. And then let's say we'll settle on a contract with a strike of $17. And by clicking on the 3 dots on the far right-hand side, you can actually choose how to enter the position, and of course, how to generate your order ticket automatically for you. So in our case, because we're looking to write a covered call, you would select opening sell. And then the next slide will show you how your order ticket will look like. So all you have to do at this point is enter in the amount of contracts, the price, and then you can also toggle between the quotes for the actual contract as well as the quote for the underlying. Now, if you want to learn a little bit more about options trading in general, we do have an educational 6-part series posted on our YouTube channel where we did partner with the Montreal Exchange to go over the basics, the fundamentals, strategies, tips and tricks along the way, and it is a great resource to utilize and watch on your own free time. Now, a bit about our commission structure. So first, we don't charge any commissions for buying and selling all Canadian and US ETFs at National Bank Direct Brokerage. So it could be BlackRock ETFs, BMO, whichever, it's zero commissions. And in order to take advantage of this, just make sure that each time you buy and sell the ETF, that it's 100 shares or more. Make sure you're placing the trade online. And finally, make sure all your documents are set to electronic delivery. And that's pretty much all you need to do to not pay any commissions on ETF trading. And if you haven't heard of us until today, then you probably haven't heard about our low commissions in general. And the good thing is that we do have something for everyone. So let's say you're already a National Bank client, then you can trade for $6.95. Maybe you're under 30 years old, then you can trade for free, and then $4.95 if you go over the 10 free trades that we give you every year. Or maybe you're an active investor and you do more than 100 trades a quarter, then luckily for you, you're only paying 95 cents a trade. And then finally, we do have a promotion that is exclusive to all those that are attending Larry's webinars this season. So for new clients that open up an account from now until the end of the year, you will get 200 free trades to use for the year. So those free trades, they also include options trade. So if you already do, or maybe you're looking to start trading options, you can do so for free with this special promotion. So conditions are very simple. You have to be a new client to us, enter the promo code during the account opening. Keep in mind that these are for trades that are done online, and make sure that all of your documents are set for e-delivery, and that's pretty much it. Also, we have some short useful videos on our YouTube channel in case you wanted to view more about our trading platform. And of course, you'll find those option trading videos as well on the channel. To conclude, if you have any other questions about our offering, my colleagues at the call center will be more than happy to assist, or you can also reach out to us directly by email. Thank you again for your time, and now on to our next speaker of the night.
Well, thanks very much, Anne. With everything going on in markets, our audience might need those free trades. So to introduce our next speaker, BMO continues to lead the ETF Canadian industry, but not just in sales, also with innovation, offering an ever-increasing array of ETF tools to help you grow your portfolio, but also to protect your portfolio. So with that in mind, live from Calgary to show you a few examples of how you can lower your volatility is ski guru and director at BMO ETFs, Mr. Rob Butler.
Thanks very much, Jared. Thanks again for including us, myself. I've done a number of these webinars now with Larry Berman and his team, and I always appreciate the viewership and the attendance that he draws, as I wouldn't be able to do it myself. So it's great to partner with a really wonderful group. In terms of what BMO has been able to accomplish over the last number of years, if you currently use BMO ETFs, you might have a sense for the numerous options you have available to you, with just over 118 ETFs on our shelf today. I mean, the business in its, let's call it broad sense, has over 39 different ETF providers that you could be working with at any given time. And that makes the research and the due diligence that much more involved in terms of coming to the right type of product that's appropriate for your intention, your goals, your risk profile, and what makes the most sense as far as transparency as well. I think that's something that people do place a lot of emphasis on. As far as where we kind of find ourselves in the ETF space, we do represent over 30% of the assets under management in Canada across all ETF providers. And they do talk about growth. And I mean, the business itself, ETFs that is, has grown exponentially over the last decade. I've been with BMO now for just under 7 years, and I've been involved in that growth trajectory. And it's been a lot of fun to be a partner of many companies such as Larry's to educate and introduce different investment strategies and bring it to the Main Street audience as well. Well, sorry, just looking at low vol. We'll transition, and I only have 10 to 15 minutes here, so let's get right into it. With regards to BMO and low volatility, that's something we've been issuing into the Canadian market for over a decade now. And for those that use, let's call it indices or indexes, you're watching BNN, you see the news broadcaster talking about the S&P 500, you hear them talking about the TSX 60 or EFI. What we've done is we've taken that general exposure that you can use in an ETF for a very low cost, and then we apply what we call a factor or a smart beta screen. And in this case, it's low vol, and that's what we're going to spend time on this evening. With regards to low vol, what we do is a little bit different from what some of our competitors are doing to derive that portfolio, or what the end product looks like. And on the left side of the slide that you have in front of you, you see the word standard deviation. And before BMO came into the low vol space, standard deviation was typically the metric or the math that was being used to derive a portfolio. And what standard deviation typically does is it looks at the volatility or the standard deviation of a particular security or a stock over a set period of time. And you'll find that most competing products will rank the portfolio in terms of its weighting to certain securities based on that particular metric. Now, the one nuance is we recognize that using beta is what enables us to give what we think is a more comprehensive review of what securities we could be selecting at any given time. And what I mean by that is beta looks at the behavior of a particular stock, but it looks at it relative to the index or the universe of stocks that we could be drawing from. And with that, we just feel as though we get a better picture of how a particular security is behaving relative to its peers, rather than simply picking a stock based on its behavior in and of itself. And we believe it also provides a higher predictability as far as being able to have a strong conviction around a particular security moving into the next trading day and beyond. Now, in the low vol space, we rotate the portfolio every 6 months or semi-annually. So we don't have an active manager that's moving all the levers, or they say they like BMO better than they like RBC in terms of its stock value and fundamental math behind it. They're not looking at that. What we do is we have a very static way to approach low volatility, and that is by using that beta screen. And by using or applying that beta screen, what you can feel comfortable with is that at any given time, the highest weighting within your exposure is going to be to the lowest beta name. And what that tends to do is it smooths out your returns. And when I say smooth out, I tend to use the word behavior and how the stock behaves. And I think Jared, in the onset and introduction there, as far as saving money in buying or selling ETFs, the concept behind this is that you can hold low vol and you can hold it through more volatile timeframes. And you can well appreciate, if you're an avid trader, you definitely know this, or even if you're new to investing, you might recognize that over the last 8 months or since March, we've seen a lot of movement in certain securities, whether that's up or down. And that's the thing, don't just focus on the down days. Low vol tends to just smooth out the overall return profile, regardless if it's up or down. And with the slide that we're going to show you here, you'll get a better feel for versus an index, remember, that doesn't use any input other than to simply track a basket of securities. The low vol approach will typically smooth out the performance or the return profile of your security exposure. The way that it's able to do that, on this chart in particular, you'll see 3 tickers at the bottom: ZLB, ZLU, and ZLI. And the way we've laid it out from left to right is Canadian, US, and international. Now, I use the explanation or the sales reference that low vol tends to win or do well for our clients without losing. And what I mean by that is when you do see significant drawdowns or negative days in the market, low vol tends to participate in less of that drawdown risk. And you can see that based on the chart in front of you. And just to walk you through it, under ZLB, and let's just keep it Canadian for simplicity, you can see that negative 27%. All that means is that on average, if the market were down, let's call it 10%, you would participate in roughly 27% of that 10% drawdown, or in this case, 2.7% on average. And remember, I can't highlight one particular day versus the next, but if you look at a security or an investment over a longer period of time, that is what the behavior profile tends to produce. And you can see that the year at the bottom there, I mean, that's looking at almost a 7-year time frame that that particular product's been performing. Now, you will see it at the same time, if markets are up, in the case of ZLB, you tend to participate in 87% of that upside performance. So it's not that you always win when markets are doing well, it's that you tend to reduce that drawdown risk. So what I love about that is if you go back to March 23rd, yes, markets have performed incredibly well since that point in time. But we all do recall, especially if we're not huge risk takers, that many of us weren't comfortable investing our money when the markets were falling or being drawn down by 30, 35% in certain categories over such a quick period of time. The concept of low vol, it reduces or mitigates you having to concern yourself when you're going to try to time, quote unquote, the market or invest that money. In theory, you should be able to sit in a low vol portfolio over longer periods of time and not become overly concerned with how the market is doing at any given time. And the particular chart we have in front of us, it talks about core holdings of a portfolio. I talk to my clients, and the way I position a low vol is it's a great core component to a portfolio construction. So the same way that a client or an investor might look for an index, let's call it, to then build around. So as an example, you have your core TSX exposure in Canada, but maybe you have a bullish outlook or a positive outlook on the tech sector, knowing that Canada, outside of Shopify, doesn't have a ton of tech names. Maybe you buy the NASDAQ to complement what the TSX is doing. So interestingly, you can use a factor or a smart beta approach as that core portfolio. And low vol being the tool that it is to reduce overall movement or up and down movement in your core portfolio, you can complement it with sectors or particular equity baskets that you do not capture in that low vol product. And Canada is probably the best example of this, where it doesn't tend to hold a lot of energy, nor does it hold a lot of gold for that matter. So as you see markets recover, and that, let's call since March 23rd, you don't own a lot of gold in the low vol approach. You do see, or we have clients that would buy some gold ETF or gold bullion alongside the low vol as being your core portfolio. So rather than having to rotate sectors constantly, stick with your low vol approach, but then build around it. Now you can see in terms of performance numbers, since October 31st, or sorry, this is as of October 31st. The overall returns, you can see here, they are producing a negative number, but that's because, and then I kind of just highlighted that without actually realizing the next slide was going to highlight exactly what we do not hold. So low vol in the case of the US, we don't hold any tech names in there because they tend to be more volatile than some of the core securities that you're going to find in there. And as a result, and I kind of gave that example a minute ago, you can use the NASDAQ as an ETF, or you can buy your Facebook alongside a low vol portfolio as your core. In the case of Canada, it's less to do with tech. It has more to do with the resource sector, where because we've stripped out energy, and again, it's not because we like or dislike energy, it just tends to be that those names produce a higher volatility or a higher beta screen than the other securities that we could be selecting, such as a Dollarama, which tends to be a little bit less exciting and not needing to take on as much risk for the return or the all-intended return that you're looking to achieve. So I think these numbers, you can look over this, and this is again a shorter period of time, and I can produce for you, and it's on our website, a 10-year number that'll show you that low vol has tended to outperform over that 10-year time segment in most geographies. So you've included here international, US, as well as Canada. I should probably highlight, in the case of the US basket, we do offer that type of investment hedged or unhedged, and I think that's important for clients to think about. And based on what we're doing in the economy and the liquidity, as far as the US and the Fed creating liquidity for that basket, it's sometimes difficult to predict what currencies are going to do. And for that very reason, we offer both hedged and unhedged versions in the event that you don't want to have to concern yourself with currency, and you're more concerned about what the equity return is going to look like. So that's my 10 minutes. Low vol, you can access everything that BMO does at BMO ETFs.ca. For those of you that work with us already, I very much thank you for your support. And if you have any questions after this, feel free to find my profile on our website, again, BMO ETFs.ca. So the reason we're all here is to listen to the founder of ETF Capital Management. A strategist and a money manager for nearly 3 decades now in the Canadian universe, also incredibly visible through BNN and on their new YouTube channel. He actually oversees 3 ETF portfolios for BMO as well, and we've been working together for, as I mentioned, roughly 7 years now. And these are products and risk-adjusted portfolios that clients tend to use in their long-term investment strategy, and as well being the first technical and fundamental manager in the Canadian market with both of those designations. And with that, I'm going to hand the stage over to Larry. And Larry, I hope you have a good presentation. Thank you.
Well, thanks very much, Rob. My tragically hip party buddy from Calgary. Thanks again to BMO and to Anne for their great sponsorship of our events. And I apologize to my sponsor BMO there for wearing my Spider Select T-shirt here as we go through. I was just listening to President Trump grovel on CNN here, and it's you know it's almost over, but I think kind of sad in a way. He did a lot of great things in a number of years, and a lot of things that I possibly would do very differently. And my dislike for his personality, I think politically, again, I fall on the right side of center, and there's a lot of policies regarding tax and business development and regulation. And he did a lot of great things internationally in terms of improving, I wouldn't say trade necessarily, but negotiations with Israel and the Middle East. And anyways, we're coming to the end of an interesting period and the beginning of a new period. And you know, we talked in the last few weeks about the nightmare scenario being on election night, we don't know who's winning. It looks like Trump's ahead. And then within a few days, it looks like Biden wins. That's how it played out. It should have been bearish, and it wasn't. And we didn't get a blue wave, but there's still an opening here. So I want to talk about a couple of these things tonight. And I want to talk about, you know, driving the Cadillac like a Ferrari and wrap that into ways to look for opportunities in markets. So hopefully in the next half hour or so, and then we'll leave a half hour for questions. So, you know, if you've been investing for long enough, there's no doubt that you've seen a chart that looks something like this, which is basically, don't worry about it. In the long run, it always goes up. Just buy, and don't worry about who the president is. And, you know, all these long-term charts and studies that say don't worry about the volatility has everything to do with a person's market EQ, or their emotional quotient, versus their market acumen, their IQ. And, you know, the acumen is what to do when and how to negotiate, and versus the emotional response. And the vast majority of people are dominated by their emotional response in markets and tend to do poorly because of that, because they get shaken out by the volatility. You know, what the strategy of low volatility as an investment factor, for many people, it could be that simple. But you've got to be able to handle a degree of volatility. And as Rob showed you in his presentation, that low vol strategy has less downside capture, not quite the upside capture, and generally does really well over long periods of time, which is not unlike what I'm trying to do with my sleep at night portfolios, and the whole idea of reducing volatility so that you can lower your EQ and ultimately have a better IQ. So question being, can you handle the ride? You know, when people write in questions and they ask about, you know, should I buy this or that, it's really, you know, your portfolio needs to be about you, not about me and what I like or how I do things. But from the educational standpoint, which is really the foundation of what Berman's call was built on years ago. And many of you don't know the whole story, but I'll tell it very briefly here because I think it's fascinating how this kind of all played out. But going back more than 20 years ago now, when ROB TV first started, they were looking for people to come on their flagship show called Market Call. And I was a strategist at the time for CIBC World Markets, and I was the president of the Canadian Society of Technical Analysts. And I got a call one day from one of their on-air anchors. They weren't on air yet, but they were about to. A guy named Lou Skeezes, you might remember Lou. He used to talk charts and that for years, and he still does a radio show, I believe. I haven't talked to him in a number of years, but he's still around. And they were looking for people to come on Market Call. And he says, it's a show where people, they call in, they ask questions. Should I buy this? Should I sell this? And you give them your spin on things and, on to the next question. I thought, oh, that'd be interesting, be fun to do. And I had done quite a lot of TV already up to that point in my role as a strategist for CIBC and my role as a strategist when I lived in Boston. I used to go on Bloomberg TV and CNBC all the time back in the mid 90s. And so I had quite a lot of experience with that. And I thought it would be, kind of fun to do. And so a couple years after going on Market Call, once a month kind of thing, the president of the station asked me out for lunch. And he said that, Larry, when you're on, our ratings are 50% higher than average, and we'd like to give you your own show. And CIBC didn't want me to do that. And when I left to start ETF Capital Management 14 years ago now, literally the anniversary is now. Jared, you forgot to mention that ETF Capital Management this past week turned 14 back in 2006. So an exciting milestone for us. And then I didn't have to ask CIBC anymore if I could go on TV. Because effectively I became my own compliance officer when you think about it from that perspective. And so there's no disclaimer here because everything I say is educational, but the idea is to give you not a fish. I don't want people looking for a tip. I want people to come away from all these webinars learning a little bit about how to do it better, about how to make a better investment decision. So the last point here is the search for total return and yield and volatility. And what that means for markets is this thing ERP. It's called equity risk premium. And it's the emotional and practical risk you need to take to get a higher return than the risk-free rate, the GIC, the bond. And unfortunately today, that risk-free rate for just about everybody on the planet isn't going to cut it. It's too low for people to get by on because after inflation, you have a negative return on the safe money. It's no longer an option, so you have to take risk in order to grow your portfolio and do better. And the question is, when do you take it and how often do you take it? So the last chart showed that in the long run, markets go up. But because we're talking presidents and whatever happens, and a lot of questions already came in tonight, what happens if this guy wins or that guy wins? Or the reality is the markets don't care. Depending on the makeup, there's some tilts here or there, but we shouldn't worry about that too much. But knowing some of these things are interesting. So when there's gridlock, and that means that the Senate and the House of Representatives are generally split. So very possible that that's the outcome here. We don't know yet, but very possible. There's a scenario that I'm going to talk about tonight where it actually becomes a mini blue wave. But if you go back and look at history and look at the total return of US large caps under the different presidents, in the year following the election, that's the graphic on the left there, you can basically see there's no rhyme or no reason, and often it's not the president's doing, it's just the circumstances. But generally speaking, when there's a split Congress, the markets on average tend to do better. And it just happens to be that under Republicans, that's a little bit better than under Democrats. But generally, under Democrats, when there's a Republican Congress, that tends to be the best. And you would think that that's completely illogical, and it is. But markets tend to like gridlock, meaning checks and balances. So money doesn't get spent stupidly by like a blue wave, like a Green New Deal. Not that a Green New Deal is stupid, but a lot of the much more progressive part of the Democratic Party would have you believe that the governments can just print money in an unlimited way and spend it, and everything will just be fine. Well, if the central banks are monetizing that, the market's going to love the liquidity, and it's going to create an asset bubble like we have today. Jerome Powell basically committed today to doing as much as possible, as much as needed to keep the party going. So rock and roll, everyone. All the stuff that I've been worried about for years now in terms of market risks, the can has been kicked again, and I'm not bullish about it. Don't misunderstand that I think markets can respond positively to me being bullish, because I'm not. I'm mortified at what's moving markets today, but nevertheless it is. So this week on Berman's Call, I talked about the need for optionality in portfolios. And that is, here's an option strategy where you can make money and buy a dip, but if that doesn't work and we go up, you can write a put to buy a call, and that's like a synthetic long, and that you can buy it lower or participate on the upside. So that's what I love about optionality, and I'll talk more about that tonight. But let's get into the meat of the presidential election tonight. Normally you would say this page is intentionally left blank because, you know, after the president's groveling tonight from the White House, I mean, it was sad to see him ramble on like that. Clearly dejected about the performance. But he actually was very impressive in terms of the ability to get more people out to vote, pull more vote from the Black community, from the Latino community, especially in Florida, where the pollsters had Biden way ahead. So as impressive as the performance was from the president, it tells you that the American people are not ready for a shift to the hard left. They want checks and balances. So a lot of people tick the box for Biden that maybe previously voted for Trump, but down ticket, they made sure their senator or their congressperson was actually the opposite, right? Because they want those checks and balances. So Nancy Pelosi lost some seats in the House. They didn't get the blue wave. We've got some checks and balances. It's going to be harder to spend massive amounts of money. Therefore, the Fed will do less. But at the end of the day, that means less inflation pressures, potentially if they don't spend enough, more disinflation, more negative real yields. Hence bullish for gold. So there's so many things that are bullish for gold. So what is Trump going to do with the Supreme Court to try to win here? And it's just, we don't know yet, because if Georgia and Nevada and Arizona all go for Biden, maybe even Pennsylvania, Trump might be able to flip one thing and get some votes thrown out, but he's not going to be able to do it all. There's probably going to be a mandatory recount in Georgia, because there's a law that if it's within, I think it's 0.25 or something percent, there's an auto recount. So a lot of that stuff is still to play out, but probably in the next 24 hours, we'll know that President-elect Biden will have some challenges ahead, but he'll be officially called the president-elect, I believe, subject to what happens in the Supreme Court and so forth. So here's the interesting thing about the Senate. the way Georgia's politics work in the Senate is very different than just about every other state. Normally, you don't have both Senate seats in a state up at the same time, but because of a retirement, both of them had come up. And so I clipped this off of the website from the Senate in the state, and it basically outlines what's happening here. But because Georgia is probably going to tilt towards the Democrats, nobody got 50% or more in the Senate races, so that we're going to go to a runoff for both those seats. Now, Alaska hasn't finished their voting, and neither has North Carolina, but those senators are so far ahead that they're going to win. There's no mathematical possibility. They just haven't been named yet. So right now, it's sitting at 48-50 most likely, with the 2 Georgia seats now going to a runoff on January 5th. This is going to be more hotly contested than anything, because apparently, I haven't vetted this, but I heard this today. If you live in Georgia, just for one day, you're eligible to vote. Bizarre to me, but if you can establish an address, you can vote. So there's all kinds of threats of all kinds of crazy things happening here. But if you look at one of the Senate seats, it was clear that there were more Democratic votes than there were Republican votes. There were about 8 or 10 candidates ultimately in the on the ballot, but more Democratic or left side candidates got the vote. So now it goes to a 50-50 on 2. So Ossoff against Perdue, and the Libertarian drops off. So his votes probably go to Perdue, which would put that seat into the GOP. But on the other ticket, it was something like 53% left type votes versus 47% right. And assuming that kind of voting holds, that seat would go the other way, in which case you would have a 51-49 GOP Senate. Now you still have Maine with Susan Collins, who's the moderate, and you still have Murkowski in Alaska, who's the moderate, and they have voted against the party from time to time, including in Utah, Mitt Romney. So you have the potential for some fracturing where when they had 53, 54 seats, even if they lost a couple, they would still win. So there's potential for the Senate to be very, very key here. But Mitch McConnell, make no mistake, who is a conservative fiscal Tea Party, doesn't want to spend money. So whatever stimulus gets passed, and it's probably not going to be until February, there'll be a continuing resolution bill in December because the funding for the government runs out. So you'll get that. They might put in with it, it won't be a clean bill, they might put in with it some measures for some extended benefits or whatever. But the big package, the $1 trillion, $1.5 trillion in that range, what it's going to be won't be till February, because Donald Trump said he's not going to make his last effort a $2 trillion spending package that's going to make Joe Biden look good. So crazy stuff, I know, but hopefully this is it for the election and we won't have to worry about this noise anymore, and it'll be on to markets and economies and earnings and everything. But this chart that I've shown every week now since we started the fall series hasn't changed. This is a problem for every retiree and every pension fund on the planet. And that is basically your guaranteed yield on your typical balanced portfolio has never been lower. And after inflation, if a balanced portfolio yields 1.37 and inflation for most people are running north of 2, don't care what the official numbers are, that you're worse off every year and on your guaranteed. So you need capital gains. And capital gains are no longer, with yields basically close to zero, no longer available in a safe way in the bond market. You must be in stocks. So how do you go about doing that? So a couple ideas for you this week, folks. The search for yield. And I look at asset classes that are cheap. Now, I haven't liked the US banks for a long time, given the flat yield curve and everything else associated with low rates. And they've been a chronic underperformer for years and years and years, and it's been a very good call. However, inflation is coming. The yield curve will steepen to the degree that the Fed lets it. They anchor short rates, long rates creep up. They'll only creep up so much because they can't handle the funding pressures of yields going too high. So they ultimately will come in and buy longer and keep the yield curve relatively flat, but steeper than it has been and not inverted like it got before. But if we go through another economic shock, you can bet long bonds are going to rally again. Now, this is more about reflation, supply coming out in the bond market. The Fed's going to buy most of it, but new supply forces interest rates up. And that was that reflation trade you hear about is about long-term rates going up. Banks respond positively to that because the steeper the yield curve, the better net interest margins are for the banks. So that's the theory. Now, when you look at an ETF like ZBK, this is the BMO Equal Weight Bank, US Bank and Financial Services ETF, we're going to look through it. But the average dividend yield on an equal weighted ETF, 3.93%. Pretty juicy yield, less than what you get in the Canadian banks, but now we're talking about diversifying here, folks, outside of Canada. I think Canadian banks are much better run on average, much more fee-based than some of the US, don't have to the extent the same capital markets risk as some of the other ones, but still have some of the same growth challenges for sure. So when I look at something like this, I want to dig into the ETF to get ideas. Okay, so I want to take the best of what BMO does in creating their indexes, like Rob talked about in what they do to create the low volatility strategies. So an equal weight bank index, they go in, they filter for the better banks. They want the higher quality financial institutions. They rebalance the ETF a couple times a year. So this ETF has 17 holdings. 17 holdings, approximately, each stock is a little under 6% if you do the math, 5.9-ish. So prior to the last rebalancing, which was probably done in the middle of the year, banks that have a higher weighting in the ETF have been outperforming. So anything above 5.9 has been outperforming. Anything below 5.9 has been underperforming. Very simple way of doing it. So you can go to the BMO website and the ETF screener every day, and you can look at the holdings in the ETF and see which ones are overweight and underweight, which means those are the better relative performers. Now, I have a Bloomberg terminal. It's $30,000 a year, not for everybody, so I've had a little bit of advantage there. But for free, you can tool around the internet and do some of these things. So the ones with the higher weightings are the ones that we're more interested in, generally speaking, because they're outperforming. But when I say you want to pick the Cadillacs, you want the better quality, better run financial institutions. So JP Morgan, US Bank Corp, have been better run overall than Bank of America, Wells Fargo, Citigroup. You can see in the large diversified banks that have trading, wealth management, underwriting, etc., that the ones that are above the median are doing better. So I'm going to have a look at First Republic Bank, because that's an interesting story. It's been outperforming. And I will look at JP Morgan because that's the big bank. It's in the Dow. It's a big name everybody knows. Not everybody knows US Bank Corp, and that's Piper Jaffray at the dealer side and so forth. So I want to look at those tonight. And one of the things that I have that not a lot of people have, but again, a Bloomberg terminal. But there's a function on the Bloomberg terminal where you can look at some of the more favorable attributes, fundamentally, technically, and some of the unfavorable ones. So when I put in First Republic Bank, you can see we're looking at that here, and I'm saying fundamentally, technically, how well is it doing on terms of positive sales surprise, earnings surprise? Are revisions by analysts higher or lower? What are some of the technicals? Price relative to the 52-week high? What's the RSI? Is it overbought? Is it oversold? Operating margins and so forth. So when there's more positive fundamentals and technicals in a name, that to me is a Cadillac. When it's an overall better run institution, it's a Cadillac. So I want to pick the Cadillacs to drive in my portfolio, but I want to drive them like a Ferrari. It means I want to trade them. I want to show you kind of how we want to do this. So on a year-to-date basis, what I did here was put ZBK, so our benchmark in terms of I want to pick some names, 2, 3, 4 of them within the US banking sector that have good yield, okay, because that's one thing we need. We need that guaranteed yield in our portfolio that are outperforming. So JP Morgan, Goldman Sachs, a name everybody knows. Fifth Third Bank, most people know that one. There's that FRC, First Republic, not a well-known name, but a very well-run bank. And then KeyCorp. And if you're familiar with Erie County, you know KeyCorp, Upper New York State, Pennsylvania, Erie, and so forth. And so when you look at their performances, which you see the total returns of, FRC is up this year, and you go, WTF, why is that one doing so much better? Why don't I just buy that? Well, short term, it's overbought. Not sure you want to buy that one here. So how do we go about looking at our charts? And this is where I say, drive it, buy it like it's a Ferrari, okay? So I look at the top chart, and that's my price line. And I look at the linear regression. This is like a Bollinger Band, except it doesn't fluctuate for standard deviation. It's trend, 2 standard deviations. So you want to look at the absolute performance relative to trend, and you want to look at the relative performance. So the bottom yellow line is FRC divided by ZBK. When that yellow line is going up, it's outperforming. Going back a year, the index at the bottom, yellow line, starts at 100. They're equal. That stock has outperformed the US bank index by 48% over the last year. Who doesn't want that in their portfolio? So when do you buy it? You buy it when it's in the lower half, or ideally 2 standard deviations below the trend. So you want to buy dips in the Cadillac. You want to get in and drive it when the opportunity is more attractive from a risk-reward perspective. That is growth at a reasonable price. That is relative value. This is how I do it when we're picking stocks in our stock portfolio. We actually just launched 2 funds for our internal clients. One day it might be out in the public, but they're for our internal clients now, that we buy individual stocks. And this is the process we use. We find an ETF that we like, and we get rid of the bottom half. Right away, we get rid of the bottom half of companies that are underperforming. Now, we might come back to those at some point because eventually it gets priced in and discounted. Okay, but screen for the top half of the ETF and trade it, buy it like it's a Ferrari. So when it's oversold in an uptrend, you add it. When it gets overbought, it's at the risk reward's no longer attractive, you trim it. That yellow line going from a ratio of 130 to 150, that's 20% outperformance over a month there, September, October. So September was a pretty good buy on an absolute basis and on a relative basis. You can see the difference between the top and the bottom graphs there, right? So going into the first part of March, very interesting. So FRC outperformed as the market was falling first part of March. Then it came unglued and underperformed by about 20%. That yellow line went down hard. Then at the end of March, when the market bottomed, it rallied and went up relative. Basically sideways but choppy ever since. Buy pullbacks. So trade it, trade them for free. If you're an active trader at National Bank. Now, when I don't want to own FRC today because I look at the chart and I say, wow, it's a little bit overbought here. Obviously, in hindsight, September was a good buy, but my indicators told me it was a good buy back then. Unfortunately, we launched the portfolio a few weeks ago and we missed that opportunity. But when I'm looking at FRC, I say, okay, I want the yield. So I want to buy this, but I want to buy it at 100. I don't want to buy it here. I want to buy it at 100. So let me look out a few months. So I bring up my option chain, just like Ann showed you that you can do on National Bank for Suncor. And I say, well, what if I write a put here to buy this? So this shows me the puts. And for the February 21, so February 19th, third Friday of the month of next year, 3 months from now, that 100 put is trading for a bid of 155 and ask of 170. I probably sell it for sure at 155. Might be able to get 160 for it if I put in a limit order on my option. So I'm earning on a $100 price 1.6% over 3 months. That's an annualized yield of 6%. Okay, that's a win for me. And if I don't buy it, I earn that 6% yield while I wait. And if I do, I bought it at a much better level than buying it at 126.83 today, right now. The other side of this, what Ann talked about, is covered calls. Now, I don't have an example of that today, but I could bring up my call and say, okay, if I bought it at 126.83 today, where would I be happy selling it technically? And I'd look at that chart and I say, well, recent highs around 131, there's probably some resistance. So I say, if I bought it today at 126.83 and sell a call for next month at 131, I could pick up an extra yield knowing that if it got back to that high, I'm happy selling it, boom, great, I'm out. What do I get for that? Let's call it $1.50. So I've picked up another $1.50 owning a stock I want to own, but I'm at risk now. If it goes back to 100, I've lost 25% or 20%, right? So right here, I don't like the risk reward technically. It doesn't mean it can't break out and go higher, okay? But I can write the put, wait to buy it or earn the yield. If that doesn't work, let me go on to my next US bank. Maybe this one is better. And sure enough, here's another Cadillac of the industry. This one isn't way overbought like that one. Where would I be happy buying this one? It might be right here. What's the upside? Well, at a minimum, 115, where we spiked to in June before there's some resistance. Looks like it might be breaking above the 200-day average. So I could go long today at 104.50. I could look out a few months and write my 115 call, probably take in an extra 1 or 2 or 3% there, writing that call. That's not bad. But if I don't want to own it here, so what I did, not today because I didn't think this was coming, I thought it would pull back more. Yesterday, I went out to December. So here we're looking at the December 18th option expiry. And I looked at where I wanted to buy it and I said, okay, support at 90. So I wrote the 90 put for $1.25. So I'm taking in a little over 1% out about 6 weeks. That's an annualized return of a little over 6%. It's a win. So now I've written options. I'm earning that 6% yield. If it goes to those prices, I get to buy it. If not, I look for something else that I want to buy today. So here's a strategy where you can earn a 6% yield while you wait to buy something at a price you want to own it at. But there are other things today that you might want to just be long with a covered call. or just long outright for that matter. So these are some of the things we're doing in our portfolios for clients. And if you want to participate in some of these, you can. ZPay, I talked about it last week. This is basically what ZPay ETF does. It earns you 6% while you wait. And it's on average long, 50% of the portfolio long with a covered call. So the market goes up, it's going to sell higher and you'll own less. And when the market goes down, you get to buy stuff at lower prices. And the whole time you earn 6%. It's a brilliant strategy. We're doing this for our clients. I love it, love it, love it. Everybody needs to learn how to do this in your portfolios, and you can do a lot of this trading for a very low cost with National Bank. Again, reiterating my buy list, everything on this list is stupid expensive. I don't want to own any of it today. It's all been rallying. It's bubble-ish right now, and you just got to wait for that pullback whenever it comes. It might not be for 6 months. If you're a momentum trader, go for it. Buy high, sell higher. Don't care. That's not me. I don't recommend those strategies. It doesn't suit my eye. So keep that in mind. So we're going to go into our question and answer period here. And as a reminder, follow the YouTube channel, the replays for events like tonight, and all our educational material is going to be on our YouTube channel. So thanks for that. Bunch of questions came in online. I'm going to do the people that wrote in first tonight here, and then we'll get to the live questions. We've got about half an hour. So Larry, really enjoy your webinars. Well, you're welcome very much, Ron. Having just opened a trading account with National Bank. Okay, great. Given China's growth trajectory, is now a good time to be investing in China or perhaps the broader Asian market? And if so, can you recommend an ETF to do so? So let me throw in our charts here, and hopefully everyone will be able to see this. And I can do, you can see futures are a bit lower tonight so far. Emerging market technology, EMQQ. Here's an interesting ETF. So when you look at it and just bring up the simple chart here, do you want to own that today, right? Emerging market tech. And again, if you're a momentum trader, the answer is yes, buy high, sell higher. But when this thing reverses, we'll get a big correction here. So it doesn't suit my eye today, but that's interesting. Here's another way for China, KBA. This is China A shares, okay? And I think this is a very interesting play. Looks a little like the other one now, but if we go back a number of years and have a look at where we've come from, there was that massive speculation in China a few years ago of the mainland market when it first started to be open access to international investors. There was a tremendous amount of speculative activity and the bubble burst. Another run up, bubble burst. Another run up. Guess what's coming, folks? We're going to get one, but it might go to here first. And that's the thing with charts that we just don't know. Nobody knows that. Anybody who tells you they know that, I honestly, guys, run from them. They don't know. They're charlatans. But it could go up a lot more first. So if you can own it, don't use your maximum position because the risk factors are high. There is a lot of momentum behind it. Certainly, if this gap closes in here in the low to mid 30s on a pullback, I would say double fisted and get very bullish at that point. So what would need to happen fundamentally for China to have a big setback here? I think we would need a global risk-off event. It would be a policy error from governments. It could be that maybe Biden comes out, inauguration, starts talking tough on China. We're going to double down on the tariffs. Who knows? But he's a China hawk, and arguably, he might be a bigger China hawk than even some of Trump, believe it or not. So we'll see how that all plays out. So good way to play China, good way to play broader emerging markets, EMQQ. there's no shortage of different ways to play these, but those are two ETFs that I use. I'm not in either of them at the moment. Thanks, Ron. Throughout the year, there's been a large disconnect between the markets and the economy. Is this an anomaly, or is this more often not than the markets really don't pay attention? So it's Paul, it's the support that the unprecedented amount of spending that Congress did, that like it dwarfed the amount of real economic hit compared to what Congress spent, $3 trillion in support programs, was more than the hit to the consumer. So arguably better off, but never in the last 100 years of every major recession that I've modeled did we not see what I talked about for months. You get the hope rally, and then you get the fade when the economic shock hits. That might be in front of us still. But if they're continuing to spend money at a colossal rate that starts with a T, as in trillions, then the market might be okay still, okay? Paul, maybe this is the same Paul, it could be different. Thoughts on the direction of the US Canadian dollar. So let's bring up our charts again, and we'll bring up my CAD chart here. I have one that I use on a regular basis that looks at a couple of different factors, some technicals. So I've got my retracement on here, looking for maximum 136 to 138 when we get a risk-off event. It'll come at some point. Whether it's a few months off is hard to say. I like the Canadian dollar CAD rate, so I like the US dollar down here. Risk reward, I think it's extremely attractive at this point. I got some of the volatility metrics, positioning in the futures market. I think as we go through COVID, oil prices stay weak. I think Biden will let Iran sell oil to the world again. So there's the potential for 1 to 2 million barrels, putting pressure on OPEC plus as we go through another downturn globally where economies shut in a little bit because we're seeing massive spikes in coronavirus all over the world. I'm just going to hit a quick update on the Worldometer page here to update my daily corona count. And the numbers, we're setting records every day. Would not surprise me that within a month of flu season here, that we actually see, globally close to 1 million cases a day with 10, 15, 20,000 people a day dying. So today's number, 600,000. The US set another daily record, 115,000 today in the US. Again, over 1,000 deaths, over 8,700 globally. So, as the case counts rise, as people get sick and tired of masks and COVID, and we're in the flu season, I've been trying to get my flu shot, haven't been able to get it. I had booked at a pharmacy. I got an email the other day, we're out. So I think it's going to be a challenging few months in front of us. The stimulus probably not until February, but right now the markets are, risk on, and we should see a retest of the highs for the NASDAQ and for the broad S&P, and at that point, I'll be looking to get a bit more defensive in the portfolios again. Not that I haven't been overall defensive, but we put about 25% long exposure on across our portfolios just prior to the election, recognizing the risk of a post-election rally almost in any scenario. So we took a little bit more risk on there. Okay, thanks for that, Paul. I was wondering if I could comment on CGL. So this is a gold, basically, the iShare. So is this something I would be buying at this point? Hasn't really done much. Well, we had a $50 rally in gold today. So let me bring up my gold chart here. And you can see the very bullish breakout of this consolidation pattern. And yeah, I think if we were to consolidate this chart and point it out, look out for the next year. I think you can project some of these trend lines up, but I think a breakout end of next year, we're 22 to 2300 on gold, and gold, so 10, 15, 20% higher for gold. Gold stocks 20 to 50% higher. So still my favorite asset class, remains the biggest holding in most of my portfolios. So I like gold here. Allison? I'm 65, manage my own portfolios, retired. I need global performance of a 3% a year to have enough money till 95. So I don't know, Dennis, if you're able to do options or understand them well enough to be able to execute that, but you can generate a yield 5-6% a year, or just go buy a ZPay and know that you're going to have half the volatility of the markets, and it's going to be way better than a VRIF in terms of an ETF strategy, which is kind of like a balanced income fund, because you've got the behavior of a balanced fund in ZPay, but you've got close to 2.5 times the yield of a typical balanced fund. So you're gonna, just the yield, Dennis, is gonna meet your need for in your portfolio. And if you can be okay with less than average volatility, then that can be a significant part of your portfolio at 65, at 35, at 85. Stephen is asking, if Biden wins, what effect will that have on the left socialist wing of the party, the Bernie Sanders, the Elizabeth Warren, the AOC part of the party on government policy? So I believe that Biden is a centrist. He's been that way his whole life. If he can't serve out his term and Kamala takes over, I believe the party will go more left. But I believe Biden is committed to more center-like policy, with the exception of the environment. As much as possible, he's going to push for environmental policy. So, for example, minutes after inauguration, the first thing he's going to do is put the U.S. back in the Paris Agreement, is what I've heard. So I don't think that's a bad thing. I think that is good for clean energy. That's good for battery. It's good for everything that's green, and ultimately good for the world. He's going to ban new on federal lands permits for fracking. And they're going to increase exports for oil, and the industry will be just fine. He talked about in the debate with Trump, when Trump got him to admit when they were in Pennsylvania that he would be banning new permits for fracking, that he's going to talk about transition to greener energy sources. And I mentioned something on my show, was it last week or the week before, and someone tweeted at me, oh, you haven't been south of Calgary for a while. The wind farms are popping up all over the place. So if Alberta wants to remain the energy capital of Canada, certainly, and the leader in the world, well, those Chinook winds are a natural resource, right? So you can create energy and be energy self-sufficient, not by burning natural gas or coal, but by wind. Is it feasible in the long run? Well, that's a whole other thing. But for a place like Alberta that benefits from that natural resource, that's got to be part of the transition plan. because one way or the other, 50 to 100 years, you're either out of the oil or you don't need it anymore, because the world is moving in that direction. Hi, Larry. I'm sitting on a good portion of my portfolio in cash. Do a research into some of my favorite ETFs. Can I recommend a good ETF screener? BMO ETFs, among one of the best. All the ETF providers have versions of screening tools where you can compare and contrast the holdings, MERs, very good. ETF.com in the US for non-Canadian, excellent resource. Last question here from Matt. Can I comment on the recent performance and future outlook for ZZZD as of yesterday's close? You can't annualize the loss in the 3 months, Matt. That doesn't make sense. But I'll explain to you why. ZZZD. So this is my sleep at night dividend ETF, and what I'm going to do here is I'm going to look at the comparative returns of ZZZD, and I'm going to compare it to my benchmark, CYH, which is a global monthly dividend CAD hedged ETF. And basically the same MER as ZZZD. So this is a global yield-seeking ETF, and I'm going to show you on a year-to-date basis. And I'm also going to put in ZDV, the Canadian dividend payers, and I'm going to show you that on a year-to-date basis. And I'm going to show you what sleep at night means. We didn't have the drawdown. We didn't get all the upside. It's like the low beta that Rob talked about tonight. Now I'm going to put in 3 of my biggest holdings in the portfolio: ZGD, gold equities, ZPay, my favorite ETF these days, and another one of my big holdings, ZWP. So when you bring those all in, have a look. Say my biggest holding, gold equities, had a great day today. It was up like 8%, ZGD, so great day. But look at the last few months. So gold equities peaked in early August, late July. I've also had a big hedge on the portfolio, which is basically SPY. So I'm using the spider to hedge market risk. So when you bring that in, my hedge is kind of in line with ZPay. So those kind of offset. I'm doing well here, but all these other things that I hold in the portfolio, I'm not doing as well on, right? ZWP, another big one that I held, EMLC, emerging market debt, high yielding debt. So that one's bounced back too. Good yielder, okay, but not doing as well as the hedge, right? As ZPay. The other big position we've had is in the US dollar. So when I look at the ETF that holds the US dollar, and this one, and if we look at that line, that's looks at the white line here. Let me get rid of some of these other ones here. EMLC. And let's get rid of gold. And let's just look at my hedge and the Canadian dollar. So you can see that since July, my 50% exposure in the US dollar has gone down 5%. So that's hurt me. My hedge, which was SPY, has actually gone up about 7-8%. So that's hurt me compared to my fund, right? So the stuff that I'm using to hedge US dollar exposure and the US market isn't working for me, okay? Plain and simple. Now, but those are 2 very good hedging tools. but we're still earning that yield as you say in your question. So Matt, hopefully that explains a little bit for you about the portfolio, what's going on in it, but we're still rocking and rolling because when we look at what it's done, so I'm going to show you BMO tactical dividend, and I'm going to show you the F-class fund, and I'm going to go back to the beginning of the portfolio. I'm going to compare that to our global benchmarks, CYH and ZDV, Canadian dividends. Oh, hold on. Let me get that in there, ZDV. So this is, again, our benchmark, 80% global dividends, 20% Canadian dividends. And there's what our fund is. So the white line, so 4.55% annualized since inception compared to the benchmark. We're doing better, way less volatility. That's sleep at night. So that's what we've done. Very happy with it, quite proud of what we're trying to do with the sleep at night dividend portfolio. So thanks for that. So we got about 10 minutes left. I'm going to get to some of the online questions now here. Okay. Sean is asking me, Larry, do you think a Republican Senate and Biden as president is good or bad for gold? So Adam, I don't think that it has an implication for gold directly, other than with a blue wave, we were going to get more spending and a weaker US dollar, and a weaker US dollar would be more bullish for gold. So it's less bullish than a blue wave, but ultimately negative real yields, higher expected inflation, which we're going to get down the road, is going to be bullish for gold. What is the reason for the rise in gold today? Jean-Pierre asked. So one possibility is the blue wave. We saw, if we look at euro today, the currency side, we look at the daily euro, we saw a spike higher. This is today in the euro. We saw volatility election day, no change, big move up today. This is after 5 p.m., so it's come back a little bit, and hence some risk off, and why some of the futures are down at the moment, perhaps. So largely, if we look at the correlation, so let's look at, actually let's do, if we look at Bloomberg, the beta screen on Bloomberg, and we look at the beta of the euro, and we compare that to gold, we can see the correlation is about 0.36. So there's a positive correlation between the currency market and gold. But the biggest correlation, if I can bring this chart up here, let me have a look at, see if it's in here or not. No. Trying to find my gold correlation chart, gold euro CPI. All graphs. Bear with me for a second here, folks. I don't realize how many screens you create after a while here. Volatility bonds. Real yield versus gold, there we are. So have a look at the correlation here between the real net, so it's the US 10-year yield minus inflation, and the correlation here with gold prices the last 5 years. And if we can blow that up, we can see that in the last 2 days, gold had to move to the up few days because real yields started to turn more negative. So very high correlation there. That's probably the answer, Pierre. Larry, I'm a current holder of DLR, so I talked about the US dollar. What's my range expectation for the next year? So let me bring that graph up again, my CAD chart here. I talked a little bit about the upside. I don't see us going back to these levels. 136, 138 is kind of my upside. I was thinking we would do plus 140 again. That, in order to do that, we'd need a massive risk-off event where the Canadian government is just dropping the ball considerably in terms of fiscal policy. Bank of Canada gets it wrong. It's all possible we do those things, Mark. But that's kind of my expectation at the moment. Range bound with that parameter, and I don't see a scope for us getting much stronger at this point. Even with a bias for a weaker US dollar globally, Canadian dollar shouldn't participate all that much because I don't think oil prices are going to reflate, at least for a couple more quarters. A lot of pressure coming from Iran new supplies, Nigeria, Libya, and from a lack of demand from things shutting down again as we go through another COVID wave. Sean is asking, Larry, what do you say about potential greatest downside market risks with the election behind us? I don't think we're going back to the March lows. Valuation, markets still below 2,000 on the S&P is cheap. And just because of the support I think we're going to get, we don't get there. So what gets us there is a spike in inflation that the central banks can't control. High bond yields spike up in the long run. The bond vigilantes come back. The Fed can't contain it. And that is bad. A policy mistake by governments wanting to raise taxes, balance budgets, not spend enough, be too fiscally conservative, economy shatters, bad for earnings, markets correct. Those are the kind of things that would need to happen for us to go back and retest those March lows. And I think that comes, but it's later in Biden's term. Higher taxes, unlikely. Maybe we'll see how the midterm elections go, but not for the next 2 years. Antitrust, there's some of that coming for sure. But the higher taxes, capital gains taxes going up, it's going to be hard for Congress to get that through. Okay, another question here. Someone asking about major energy companies. For a trade, oil stocks, I'm good for a trade here. But I think we're going to get pressure through the winter on oil prices. Probably you want to buy dips. But I'm not bullish on it. From a trade perspective, yes. ZWE, I want to build a position. What happened to it at the end of October, and if US dollars go. So ZWE went down because European stocks went down. I prefer ZWP right now to ZWE because I want the exposure to the euro versus the Canadian dollar. I want the exposure to the British pound versus the Canadian dollar. So I'd be playing ZWP. In fact, I am. If you see and look at the volume on ZWP in the last couple of days, you'll see a massive volume spike. Maybe I can just show it to you here. ZWP, and we can look at that chart. And I can put in, show you the volume here. Let me add volume to the chart. So that was me. We bought almost 10 million shares, nine point something million shares, just setting up before the election here. So those are the things I look for these. I look for these dips to add to my exposures where I've been looking to buy. You can see where ZWP is relative to everything else in the US that's making new highs, that's an attractive place to clip a 7% yield off of, and we added that to all our portfolios. So we're out of time. Once again, thanks so much everybody for your questions and for being with us here throughout this whole series. Again, if you're interested in our BMO portfolios, go have a look at ZZZ portfolios. If you are interested in what we're doing with stocks and options and think some of those yield strategies are for you and want an opinion on your portfolio, by all means, reach out to us at etfcm.com. There would be a link in the feedback survey for you to do that. If you're interested in fee-based, unbiased financial planning, U-Potential is the best. And if you are a financial advisor and you are interested in potentially being a partner of mine, have a look at Q Wealth. We're doing phenomenal things for investment advisors across Canada, and we're growing our partnership network with advisors across Canada. Folks, thanks very much. Please consider a donation for sick kids and leukemia and cancer research. Helps all kids across Canada, and dementia and Alzheimer's research at Baycrest. Again, a global scope here with a world leader in research in these key areas based here in Toronto. Thank you very much, folks. Have a great week. Stay safe, and we'll see you next Thursday and Mondays on Berman's Call.